How's everybody doing this morning? I've got the, first of all, as always, I want to thank Mauricio and everybody over at FX Street. They always do a good job, and I appreciate them inviting me to do these webinars. I certainly encourage questions along the way, and if it's a question that has some relevance to what I'm talking about, don't hesitate to ask it, because it's a good way for me to probably add a little bit more color to the subject that I'm already discussing. And so feel free to type in any and all questions into the box there, and I will certainly address it. What we're going to talk about today is probably on most people's minds recently, and that is basically the state of the markets. And when I say the state of the markets, I mean in terms of how quiet and choppy it is. Now, I have a chart up on my page or up on the screen here, which is of the S&P 500. And if we go back and remember some of my previous presentations here at FX Street, I've often said that getting a good read on what the major asset classes are doing is really critical in terms of understanding how to trade the FX markets. So obviously I spend a fair amount of time analyzing the S&P 500, not only for FX, but I do a fair amount of stock and options trading too. And when I say a fair amount, I may do 3-4 trades a month in options or individual equities. But what we have, and you might be saying, well, geez, Dave, you said it's kind of a sideways market. You're right. We have had basically about a 12% move up off the February 12th low. But in the recent weeks, what we've had is a lot of narrowing and contraction of price action. As you can see early on in the rally, and this is always the case, you get wide-ranging bars. And we're on a 4-hour chart here, so each of these candles is representing 4 hours of price action. So you get a trend, expansive candlesticks, or in this case, expansive candlesticks. But as this rally's worn on, these candlesticks have become narrower and narrower. And the other thing that I'm noting is that we're getting a lot of overlap between, in terms of the peaks and the troughs. Here, you didn't really have any overlap. Straight up, little pullback, new highs, or at least, new highs within the context of this move off the low. But as this move has continued higher, we're starting to get narrower price bars and a lot of overlap. And what that basically does is it really prevents you, unless you're a very nimble day trader, from really getting a high level of conviction on trades where you can maybe be in them for several hours or several days, which is really what I like to do. I know for many traders that can be frustrating. You show up at work each day and you're thinking there needs to be something to do. And in a normal job, that would be the case. But that's not always the case in terms of trading. We can't really impose our will on the market. We can only trade what the market offers up. And from my perspective, if, again, you're swing trading, I'm not talking about intraday scalping type trading, although that gets impacted too, because a quiet market, regardless of the time frame you're trading on, becomes quiet, whether you're intraday trading or swing trading. And let me just type in one thing here. I want to put something in the post here before I continue on here. Just give me one moment here, sir, folks. I'm just going to put a link here in the chat room for people. That's a blog post I wrote about basically not quiet markets necessarily, but showing up for work as a trader, but sometimes not always having something to do. That's very unlike traditional occupations where you show up to work and on Wednesdays you do this set of tasks. On Thursdays you do this set of tasks at a particular time in a particular place. Trading, of course, isn't like that, but I think newer traders have a tendency to think if the market's open, there's got to be something going on somewhere, and they sometimes go on this endless quest for trade setups that may or may not exist. And I would say in a quiet market, yes, there's always going to be somebody who might be able to grab a few nuggets out of there and make a couple of trades. But by and large, a quiet market impacts everybody across the board. It's really, really important to stick to your knitting, so to speak. Stick to your discipline, stick to the trade setups that you have. And if there's nothing that's jumping out at you or the risk reward is not there, it's okay to not trade. So that being said, the S&Ps, the way I have this counted out right now from an Elliott wave perspective is that this narrowing and contracting price action has a tendency to unfold with a break to the downside. If we had this chart flipped upside down, we'd be looking for a move to the upside. But this is a move that's going up and it's becoming labored. It's becoming more contracted, as you can see from this shaded area right here. I thought that the bombings in Belgium this morning perhaps would have been a catalyst because they initially did drive markets lower. But as has become the case with these terrorist attacks, they are largely shrugged off. The question now becomes is really how much more upside is there in the S&Ps? And again, I'm not saying that there has to be a move lower here. I'm just saying that would make for more optimal trading conditions. I don't want to be either trading the S&P or the underlying stocks to the long side or trading FX markets expecting the S&Ps to move higher, because to me, I'm chasing my entry at this point. This has been a long and extended move already, 12% in a just over a month. It's a pretty powerful move. It's not to say that it can't go higher, but for me as a trader looking at reward to risk, I feel like I'm picking up nickels in front of a steamroller here. Therefore, I'm not really keen to, let's say, get long the Aussie dollar, which would tend to benefit from a higher S&P 500. I'm not really keen to, let's say, get long the Kiwi dollar, which would also kind of benefit from a stronger S&P. The ideal trading situation in here would be for a minor 5-wave break lower. Let's say we're on a 15-minute chart and we catch a little 5-wave break lower. I'd be much more inclined to be short the market, and I put that in quotes, because I think there's more downside right now than upside. I'm not saying that I'm being bearish on the market. I'm just saying I want to see a move lower, because I think that's where we're going to get a little bit more juice, and that's where we're going to get what you would call range expansion. You're going to get price bars that are going to move lower and could probably help us test 1957, test down towards 1920. Those are big moves that we can sink our teeth into as traders. I'm assuming everybody, one person on here says there's no sound. Is that gentleman the only person that can't hear? I believe the volume was working just fine. Mauricio, I assume you can hear me, yeah? Yeah. Thanks, Adinda, I appreciate that. Okay, Jake, it looks as though there might be an issue on your end. I believe everybody is getting the sound. You're the first one who's asked about it. Obviously, you can't hear me, so I don't even know why I'm talking to you. But I'll just type in something here to poor Jake. Jake, sound is fine, likely an issue on your end. So that's what we have in terms of the S&Ps. You can also make a similar case with the dollar index. And let's bring up the dollar index right now, because that's the other major component that I look at. I think it's possible. It's possible we might still have one more move lower in the dollar index, at least based on the wave count that I'm looking at here. Let me just shrink up. Let me expand that count just a little bit. I'm thinking that dollar index probably can go down into the 94, 93 area based on the wave count. My level that I'm looking at right now is if we get above 95, 94, I'm willing to call this correction complete back here at the March 18th low, in which case, if anybody wants to answer this just so that I know that everybody's following along with my logic here, if we get the dollar index to move higher, what is that going to do to the price of the euro? What will that do to the price of the British pound? And if everybody just wants to type in an answer, I would appreciate that. I just want to make sure everybody understands the correlation between the two. I know it's a very rudimentary, basic question, but there might be a couple of new traders in here that may not know that correlation exists. So let's just make sure everybody's on the same page here. Now that is correct. If the dollar index rallies, the euro and British pound would obviously fall in value and vice versa. So it looks as though we're trying to carve out a low in the dollar index. But again, let me go back to that whole sideways market theme, because this chart here is quite interesting. And just for the time being, ignore the wave labels that I have on here, because that's not the point I'm trying to make here. But if we go back to the high back on March of 2015, and we look at all of this price action since then, there have been pockets of volatility, but the fact of the matter is we've moved sideways for over a year now, largely speaking. Pretty tight range, actually, about 7-point range in the dollar index. That makes it really, really difficult. Now, again, I'm speaking more from a swing trading perspective. Makes it difficult to establish trades and see those trades play out, because what this price action looks like on a day-to-day basis. It's easier to go back in time and go, oh my God, this price action's horrible. There's been no trends. It's just been a lot of chop and a lot of back and forth. When you live this price action day in and day out, what you see on the charts is up a little bit, down a little bit, up a little bit, down a little bit, up 2 steps, back 1 step. There's no continuity. Yeah, there are trades here and there, but I think we all know I want to be trading in a market where price action is trending higher or trending lower. We don't have that right now. Based on the wave count I'm looking at, though, it's possible that we might be carving out what I would consider the wave 4 low. And I'm going to say that, between 94, 93, 94 to 93 is a likely support area. And if we get down there and we start to rally from that, that's going to be very encouraging for me. Or if we get back above 95, 94, that would also be encouraging as well. And at this point, as I've been telling my clients in recent days, until we get some clarity on that, dollar-based pairs like the euro and the British pound are probably not the most ideal place to be trading. I've been spending a lot of time with the crosses lately, not with any greater degree of success, because again, quiet markets are quiet across the board. You're not usually going to ferret out a particular market or a particular currency pair or a particular stock that's bucking all of that and allowing you to mint money with really, really clean and crisp setups. But I have been looking, based on my S&P outlook, thinking that we might begin to break lower a little bit. I have been focused on shorting Kiwi yen. Haven't done anything yet, and I'll show you that chart in a moment, because that's just as sideways and choppy. But I'll give you some reasons why I'm focused on that, because I see something in between the lines, so to speak, and I'll go over that in just a moment. And I've also been looking at euro sterling. Now, I was looking for a break lower yesterday in euro sterling of 78. That did not happen. And since then, prices have rallied, likely more a result of the terrorist attack and the associated implications of the Brexit and whatnot. But the bottom line is price action is moving higher now in euro sterling, and I'm going to reevaluate that. So I'm going to go over both of those in just a moment. But I did have a comment in here I just wanted to get to. It's from Dion. It says US dollar index goes up when euro goes down. I would just rephrase that. It's usually the dollar index that's driving the euro and not vice versa. I mean, that's a minor point, but I think it's important. It's kind of like saying that Apple's going up and therefore dragging the S&Ps with it. I'm not saying that that can't happen because the S&P is a weighted index, but the better way to look at it is as S&P futures are going up or as dollar index futures are going up, the representative currencies, you know, fall or rise relative to that move. So I just think it's just a small distinction I want to make. But your other point's actually quite good. It says the pound also goes down as the dollar index rallies, but with a smaller correlation. And the answer is you're absolutely correct. Because if you go back and look at the components of the dollar index, I think 57% of the dollar index is made up of the euro. It's the largest component by far. Therefore, I can't remember how many other currencies are in there. It's obviously British pound, Swiss franc, Swedish krone, Japanese yen. Can't remember the other ones. But they all have a smaller and smaller proportion of that dollar index. So you're correct. The correlation, or let's say the sensitivity to a move in the dollar index is felt far less on pairs other than the euro. But nonetheless, there is still a correlation. But I think it's a great observation, Dion. Yeah, Canadian dollar, that's the other one. Thank you, Jack. And then Dion, the dollar index is in fact a bundle of currencies. And if you just look up on Google, you know, dollar index components, it'll pull up exactly what's in the dollar index and make it quite clear. So that being said, I've been looking at Euro Sterling. I've been looking at Kiwi Yen, and I've even been looking at Aussie Kiwi. So I'm trying to focus on the crosses, not the dollar-based pairs. But I can tell you, if we can carve out a low in the dollar index or break above 95.94, then I'm going to completely, you know, reorient where my focus will be, and it will be on pairs like the euro or British pound. In fact, I would be willing to say that based on the technical pattern right now, and I'm not saying that the British pound is a leading currency because it's certainly not, but the technical pattern that I see in the British pound right now, and I floated this idea out to my clients earlier as a longer term trade idea. It looks to me, in terms of the British pound, that we're moving lower. I mean, ideally over weeks, we might get down to about the 132 level, currently trading at 142. And I would say that 143, or call it 144, or if you wanted to be a little bit more generous, maybe 145.27 would be a stop loss. I know those are wide stops, but this is a longer term setup based on a daily chart. But again, if you adjust your position size smaller or lower, you know, who really cares what the size of the stop loss is, because you're trading a number of lots that's commensurate with whatever your risk tolerance is. And that's a topic for a different webinar. But, you know, position sizing is really critical, keeping your risk consistent on a trade by trade basis. And more importantly, one of my pet peeves is when I hear people say, oh my God, that stop loss is too wide. And I'm like, trade smaller. It's not that difficult, you know, trade smaller. Therefore, if you get stopped out, you're still risking what you would have made, or risking what you would have if you traded, let's say, one standard lot with a 30 pip stop loss. Now you're just trading one mini lot with a 300 pip stop loss. It's no different. So just think about it that way. And again, it's a topic for a different day. I don't want to go into that today, but don't be scared by the fact that, you know, currently at 142.26, your stop loss might be at 145, you know, 300 pips away. Who cares? Trade smaller, real simple. So I do think that this has some merit, and I might nibble at a little bit of this because I think it's certainly a compelling move. We also have a stochastic that's overbought on a daily basis, which historically has pointed to lower levels. So I kind of like this trade setup, and it also dovetails in with what my suspected forecast is for the dollar index, which is for the dollar index to get a little traction and move higher. But let's go back to the other one I was talking about, which was the Kiwi Yen. And I've been talking all day about sideways, price chop, and all that kind of nonsense. And as you can see, we've had a fair amount of price chop in here on Kiwi Yen. And again, Kiwi Yen should move lower as the S&Ps move lower. But as we all know, the S&Ps don't move lower anymore. They just go higher because that's the new norm. I'm being obviously very sarcastic. I'm getting a little tired of this grinding Pollyanna type market that's kind of been engineered by the Federal Reserve. But again, that's a topic for another day as well. I don't want to get too much into the grandstanding aspect of trading, but I've been in this business a long time, 21 plus years. And I have to say the way price action trades nowadays is just doesn't even resemble what we've seen in years past. We have such a market that is engineered, and I'll use a very soft term like engineered, that it's just mind-boggling how we have reduced volatility to nothing because interest rates are at zero, or in some parts of the world, sadly, they're negative interest rates, and it just really warped the whole price discovery process. And as a result, what you see on the screen in terms of price action is a direct result of what I would call these flawed, and I'm using flawed in a very gentle way, flawed policies. But here's the nugget I take out of Kiwi Yen here. Yes, there's a lot of sideways chop. However, each of the moves lower is always in 5 waves. 1, 2, 3, 4, 5. Correction in 3 waves. 5-wave move lower, 3-wave move higher. 5-wave move lower, albeit a leading diagonal as I have it labeled, but this is clearly a corrective rally. 1, 2, 3. Then we get this break overnight back below 75.63. In fact, the level I was looking at overnight was 75.75 because again, that creates overlap. But again, market doesn't want to go down. We had a nice big spike lower on the bombing, the Brussels situation, and prices have come all the way back because prices just, they just don't have follow through. A little bit more follow through to the upside, a little less follow through to the downside. It just makes trading really tricky. But I'm still focused on this cross because I do think there could be an opportunity if the S&Ps were to break a little bit lower. Hasn't happened. It started to overnight, but again, world peace has been restored. The economy's robust. Everybody's loving life, and everybody's wealthy. So therefore, the S&Ps are only off 0.05% on the day. So again, yeah, do I sound a little jaded? Yeah, I am a little jaded because this type of price action really, really tests one's discipline and patience. And everybody, you want to come into work every day and have something to do. I realize that you can't have a trade on every single day, but when you go on and you're just not getting good setups, or you identify some setups and they don't play out, or they never trigger and follow through, you start to get a little bit frustrated. Luckily, when traders' level of frustration gets a little high, and I've been getting emails from clients going, my God, this market's tough, it's frustrating, blah, blah, blah. I could tell that, and even for me, I'm getting frustrated too with the level of the way the market's been trading. What I know from my personal perspective is that that's typically an early indication that things are about to break in terms of getting more robust price action. Could be today, could be tomorrow, but typically when everybody gets kind of hot and bothered, that's typically when we'll start to see price action improve. But until then, what I'm basically doing is I'm kind of on observation mode in a big way. I'm looking at Kiwi Yen, I'm looking at Euro Sterling, I'm looking at Aussie Kiwi, and I'll show you those other 2 pairs in a moment. But until we get those breaks lower, it's really tough for me personally to make some trades in here. I don't have a very high conviction level. Again, the exception being if you're a short-term intraday trader who might be in a trade for 5 or 10 minutes or maybe a half hour, yeah, there might be some opportunities. I will grant you that. But the bottom line is, even though there might be opportunities, they are less robust than if the overall market was moving in a more fluid manner. And I think that's pretty fair to say. Let's check one thing here. All right. So the other currency pair I've been looking at, and I think this theory might get blown out of the water, but I've been looking at Euro Sterling. I'm sorry, not Euro Sterling. I am looking at Euro Sterling, but let's look at Aussie Kiwi first. Again, using the wave count as a way to identify a possible entry point, I've been wanting to get long on this recent pullback in Aussie Kiwi. We did have an initial move lower, but based on the way the wave count is and based on the way markets trade, that's probably not the completion of wave 4. Wave 4 is probably going to unfold in an A, B, and a C, and that will take it back towards 111. Now, I thought last night when we started to get this move lower that wave B was in place, and I'll show you what I was thinking, and then we'll go back to where the count is now. I thought we had wave B in place last night as we started to get this move lower, because what ended up happening, I'm just going to draw this in. I'm just recreating what I had posted to clients last night. I said, we're starting to get a trend line break here. Wave B went up in 3 waves. We had overlap of that high at 112.22. But again, we started to break lower, and I'm like, great, we're going to get an opportunity to be a buyer down into this level. And this level is simply a function of Fibonacci levels of wave 4 relative to blue wave 3, and then wave C relative to the distance of wave A projected from what I believed was the wave B top. So again, 111, 110.70, I was like, great, we're going to get an opportunity to be buyers in there. Get up this morning, not so much. We're now putting this whole theory or forecast to the test. If we get much above 112.80, my count is off a little bit. It doesn't mean that I'm wrong on my forecast in terms of being bullish. That remains correct. What is unfortunate is that I'm not able to be a buyer at a level that I really wanted to be a buyer at, which is down into this 111 area. That still could happen. Again, 112.80. I'd love to see prices move back lower. If they do, fantastic. I would love to be a buyer down in here. Now, I'll give you another example of another trade I'm looking at, and then I'll take some questions and answers. And this is Euro Sterling. Last night, or I should say yesterday, and let me bring it to, let's say, a 2-hour chart. Yeah. We came really close. I wanted to be short Euro Sterling, and we issued a trade alert. I issued a trade alert yesterday to get short at 78. Prices got down to 78.04 and then have ripped higher. We would have been stopped out. So I'm really grateful we did not get triggered at the 78 level. And what that's forced me to do again is, forecast gets turned on its nose literally within hours. So what I was expecting, this is what I was looking for before, just so you're clear on where I am and where I was. Now, if we ignore this price action here, what I thought we had going on was this. A, B, and then down to C. And I thought we could short that last leg in wave C down into the, probably, 76.30, 76.50 level. I thought that was a great trade setup. That appears obviously not to be the case. What we might be looking at now is this. Wave 2 is in fact complete, but I have to admit, this is a little funky to get my head around in terms of the wave count, but the best way I see it right now is this is wave 1, wave 2, this is wave 1 of 3, wave 2 of 3, and now we're in wave 3 of 3. So if that is in fact correct, I don't even think it's going to show on this chart because I've got it way off the screen. If in fact that wave count is correct, and again, keep in mind, this is a weekly chart, so I'm not talking about something that's going to happen tomorrow. The longer term count suggests we could be heading towards 91. Again, that's getting way, way too ahead of ourselves. But if in fact that is the overall beginnings of the trend, get this out of here, that does help us get a handle on where we're going in the near term, because you could take that larger degree move and really break it down to a more granular level. So I take wave 2. Again, this is making the assumption that this is in place, and I'm not saying that it is. Then we're probably looking at something like 1, 2, 1, 2. You know, we're probably looking at a move. Certainly, if we get above 79, you know, we're probably going to go up towards the 80 level. I think that's a pretty safe assessment. And I would say at this point, based on the way I'm reading the chart, and again, I'm just doing this on the fly. I need to go back and probably give this a little bit more granular detail. But I would say if you were considering being long at this point in time, I wouldn't give it any more room than 78.36. If we go below this particular swing high right here, this potentially bullish wave count right here, and I say potentially because I've really got to go through and give it a think, would be invalidated. So we know at bare minimum, if you wanted to get long here or even buy a pullback, your stop loss has got to be at the 78.36 level. And from an FX standpoint, that is exactly Oh, is it? Okay, I'm sorry. I just got distracted here. Oh, okay. Thanks, Mauricio. I don't see. Oh, I see. Duh. Hold on, folks. There it is. I'm sorry. Here's that. God, having a brain fart here over in this end. Here's that link that I wanted to post regarding you know, trading as a job and how traders don't trade as a 9-to-5 job. So sorry about that. There's the link right there. It was a blog post I wrote like a year or two ago. I wasn't logged into this particular platform there, but I am now. So I just put it in there. So again, that is what's on my radar screen. I'm not looking at anything else at this point in time. Because again, one, those are the charts that I've picked out that are resonating with me. But again, it makes it hard to do anything with them until we get some clarity in the overall markets, which is why I'm ignoring the dollar-based pairs for the time being and focused more on something like Euro Sterling or Kiwi Yen, because Kiwi Yen is what I would consider a catalyst trade. If the S&Ps are to break to the downside, as I highlighted, Kiwi Yen has the requisite, and that's not placed properly, the requisite technical picture in place to move lower. But again, unless the S&Ps move lower, that will not happen. And that is what's on my radar screen. And frankly, in this type of a market, to have two ideas that are reasonably compelling, I think is pretty good. And again, I haven't made a trade all week in terms of the FX markets. And we did not make a trade last week either. We had a couple of trades that we placed, but we never got fills on. That's becoming more common. You know, I've got these limit orders or these sell stop orders out there or buy stop orders, and they don't get triggered and prices fall away to the other side. So that is kind of the nature of what's happening in this market. And some of you might be saying, oh my God, no trade in almost a week and a half. Well, what's wrong with that? Who said you have to trade every day? I've never read a book where somebody said the hallmark of their trading success was frequency. Never. George Soros wouldn't say it. Paul Tudor Jones wouldn't say it. And any of the other heavy hitters of our day or any other day. You're fooling yourself if you think trade frequency is the key to success. If you trade for entertainment, best of luck to you, but you won't last. So the reason I'm not doing a lot of trades in here is because I don't see the reward relative to the risk. And keeping my powder dry is far more valuable, because if you beat yourself up in a choppy market, when the market does loosen up, you'll be too punch drunk and too jaded to take advantage of the opportunities that will be presented to you at that time. So unless there are more questions and answers or more questions, that's all I have on my docket for today. So I'll give you folks a moment or two to type some questions in, and we'll go from there.
Pan, I appreciate that comment. I think what you'll find is that seasoned traders trade a lot less than you think. Again, it's about picking your spots, and it's about being very selective and patient. Again, there's no ribbons and no trophies given for someone who's haphazardly and sloppily placing trades. That never, ever works. Just remember that. Read that blog post that I put up there about traders don't work a 9-to-5 job. The fact of the matter is you can only trade what the market presents to you. If the market is not presenting anything that dovetails in with your trading methodology, there's nothing you can do. It doesn't mean that you've had a wasted day. It doesn't mean you've not been productive. Fact of the matter is the market didn't set up in the way you needed it to. You just wait and move on. Another question is, do you see any gold speculation at this time? It's hard to know, what's buying versus speculation. I will tell you that I've been bullish gold for about the last 6 to 9 months. That's been quite fruitful. I was patient enough to not buy it on the way down over the last 2 years. So I am long gold. I am long some of the miners, and I do have some bull call spreads on GLD, which is the ETF. So that's the one thing that is working for me at present, and it's been working for the last few months. I think right now gold's consolidating a little bit, and I would probably use that as an opportunity to maybe add or build positions. But in terms of knowing if it's speculation, I wouldn't think, I guess the more I think about it, there's no way it can be speculation on gold because gold is so beaten down. If we were talking about selling short gold, I would say, yeah, that might be speculation because it's at such low levels. But in terms of buying gold, no, that's not speculative. In fact, anybody who's buying it in here is probably more bargain hunting or looking for an asset class that's truly underpriced relative to where I think it could go in the years ahead. I understand your question, Dion. I've never found that to be a particular useful way because, one, I don't typically trade some of the underlying components of the dollar index. I don't trade the Canadian dollar, largely speaking. I don't trade the Swedish krone. Trade the yen and Swiss franc occasionally. I tend to be more of an Aussie and a Kiwi trader, trade euro, that type of thing. But again, given that each currency has a different weighting in the dollar index, you'd have to analyze each currency and then try to project that the impact it would have on the index itself relative to its proportion. I just think you're way overthinking it. Just think of the S&Ps and the underlying stocks. It's the dog and the tail wagging, not the tail wagging the dog. If the dollar index is moving higher, that's because the euro is moving lower, British pound's moving lower, Canadian dollar's moving lower, Japanese yen's moving lower, and the Swedish krone's moving lower. Not the other way around, because even if the Swedish krone was on fire and moving higher, it has such a small representation in the dollar index that the dollar index, largely speaking, will probably not even be impacted by that. So again, don't overthink it. Just look at the chart of the dollar index and make your assumptions from that. It's one thing traders always try to do. They try to make it more complex than it needs to be. If you focus on the dollar index, you'll get a good sense of where the euro is likely to go, where the British pound, the yen, etc. But again, as you get into the currencies that have less and less of a constituency of the dollar index, that becomes less relevant. For me, the dollar index is a great tool to analyze where the euro is going. Much beyond that, I don't look at the dollar index and go, well, let me take that back. The good rule of thumb is if the dollar index is trending higher, you don't want to be buying the euro. You don't want to be buying, let's say, the Aussie dollar, even though the Aussie dollar is not a component of the dollar index. But if the dollar is moving higher, you don't want to be going against that. You want to be going the opposite way in those other currencies. I got you. Well, I'm glad you're still chugging along and doing this type of work at 80. That's good. That indicates to me it's a labor of love. It's probably where I'll be when I'm 80. I love doing this. It's not work. I have a friend of mine who says, you know, you haven't worked a day in 21 years. And what he means by that is I don't really consider my job work. It's really a lot of fun. So I'm glad to see you're doing it. But that's all I have for today. Unless there's a last minute question that I can address, I'm going to wrap it up with this, and I'll be back in 2 weeks. And hopefully we'll have the market kind of shake out a little bit between now and then, because I'd love to be in here talking about some really solid trading opportunity. But right now, again, be very patient. There's no shame in sitting back and waiting for trades to come to you. There is shame by not keeping intact impulsive behavior. That's far more shameful. And if you do get a winning trade, it's probably because you got lucky, not because there was any skill involved. The real skill right now is being patient. And if anybody who tells you different, they've not been around long enough, or they're just lying to you. That's the simple truth. So again, appreciate everybody here. Appreciate the folks at FX Street. Have a great morning and a great afternoon, depending if you're over in Europe or what part of the world you're in. So we'll talk soon. And for anybody who's interested, 80th day as a trader. I'm sorry, I misunderstood. Okay, well, either way, yeah, I'll flip that comment around then. 80th day, it's a long journey, my friend. Don't try to get too ahead of it. I don't know what you do as a profession or what you did as a profession, you know, if you're retired, but everybody who's good at their profession spends a lot of hours and a lot of days perfecting it. Trading's no different. Sadly, it's been packaged as something you can learn in a weekend. That's a bunch of BS. It's like any profession. It's as much art as it is science. And the longer you do it, the better you get at it, but it's very incremental. If you don't have success in your first year, that's not really that uncommon. That's kind of the norm. So don't get discouraged. Trade small, perfect your skills, and you'll be around for a long time. What I will say, I'll leave you with this, just a little bit of for those that are interested in my approach. Bear with me for one moment. If you want to get a flavor for what we're doing in terms of both stocks and FX, I encourage you to take a trial to either of those services for $1 for 30 days. It'll give you a good sense of how I trade and the specific analysis that I provide to clients. And I'd love to have you on board. So again, thanks to everybody, and have a great morning and or afternoon.